Hello, my name is Richard Claywell, and this is Litigation Speaks. Welcome back from the holidays. This is the first week of January 2022. I hope you had a Merry Christmas and a Happy New Year. What I want to do today is talk about a previous presentation that I gave. It relates to business valuations and a thing that's called depreciation and capital expenditures. In a previous presentation, I made the comment that if in the last year, the terminal year, you see that the depreciation expense and the capital expenditures are the same, it's wrong. And I just left it at that. So what I want to do today is talk to you about when you do a business valuation, why those two numbers should not be the same. We have a problem in this industry of battling experts. One expert will say it's all right to have those numbers to be the same. Another expert will say that they should not be the same. So what I want to do is clarify for you why they should not be the same. So I'm going to talk to you a little bit about this, and I want to give you a little table or a chart that shows you mathematically why those two numbers should not be the same. The capital expenditures are assets that we're going to acquire through the life of the business. So we're going to forecast and we expect to purchase X. Then we're going to depreciate those assets over its economic useful life, not over its tax life, because when you do a business valuation, the financial statements are supposed to be adjusted to generally accepted accounting principles, also known as GAAP, G-A-A-P. Tax basis and GAAP basis are not the same, and the business valuation literature states that the analysis should be based upon GAAP. A lot of times the analyst will state very specifically that they're going to do this for convenience, and in my opinion that's just a lazy way of saying I don't want to take the time and effort to sort out the complexities of actually calculating the capital expenditures and the related depreciation for that. When we do our projections, the capital expenditures are determined first, and the depreciation is based upon the capital expenditure. We need to estimate the economic useful life, not necessarily a tax life, but an economic useful life for that particular asset, and depreciate that asset over that economic useful life. If you see from year to year to year that, assume for the sake of argument, we have $100,000 over the last 5 years that we have a capital expenditure, and you have the same amount for the depreciation expense, more than likely that's going to be a Section 179 tax election to expense those assets. That is not GAAP. So those assets should be depreciated over an economic life, not expensed based upon the tax code, Section 179. I do not have a problem with the people electing the Section 179 and deducting that for tax purposes, but when you do a business valuation, that is not the way it's supposed to be done. So what I've done is prepared a little chart for you, and the chart will show you why those two numbers should not be the same. If they are the same, I think that you have a huge problem with your expert or the opposing expert, because this will flow down through the remainder where this is located on the forecast. From there down, everything will be incorrect, and that could be 20 or 30 calculations that are going to be incorrect because of this one item. What you do is when you buy an asset, you buy it on today's dollars. That historical cost is depreciated over, assume, 10 years. The capital expenditures that we're going to have to buy every year to replace that will include inflation. So what you have is you have a historical cost number that's being depreciated, and you have a asset cost as you replace those have to be replaced with original cost plus inflation. So if on the table that I've prepared for you, if you look in the column that says capital expenditures, you'll see at the end of year 10, for example, it has $1,305. If you look at the total depreciation that's been taken over this particular time period, it's $1,146. and I just use 1,000 because the number is easy to work with. When you do that, the depreciation expense, the capital expenditure at the end of that 10-year time period will be 87.9% higher than the depreciation expense. So if you walk through the math, you buy the asset, you depreciate it, you buy an asset, you replace it or continue to increase the capital expenditures because of the growth that you're having is $1,305,000, and that's 87% higher than the depreciation you're taking on the same assets that you're acquiring. The chances of those two numbers being the same are basically none and none. So if you see that and you have a battle of the experts where one expert is saying that in my business valuation, I get that the numbers should be the same, and the other expert says in my business valuation, I get that the numbers should not be the same, and here's why, the correct answer is going to be for the business valuation that was performed where those numbers are not the same. So hopefully this will let you understand better why the depreciation and the capital expense should not be the same. Again, if they are the same from that point down on your discounted cash flow analysis, your numbers will all be incorrect. Thank you for being with me again. We'll see you next time. Thank you.